A number just crossed the screen, $81. And if you are watching this because you think that number is a victory, you are holding the wrong file. Here is the open question this briefing will answer. If silver just hit $81 per ounce, the highest level in over a decade, why are physical vaults in Singapore reporting 8-hour wait times? And a $5,000 minimum just to get your hands on the metal? That is not a supply chain delay. That is a mechanism running. Most people believe that when a commodity price rises, availability increases. Higher prices attract more sellers. More sellers flood the market with supply. The textbook says scarcity corrects itself. You see, that is the official narrative. And the official narrative has a function. Its function is to keep your capital inside the system long enough for the extraction to complete. The data tells a different story. On the COMEX exchange, the primary paper market for silver pricing, the average spot price is registering at $55.20. $81 on your screen, $55.20 on the exchange floor. The gap between those two numbers is not a rounding error, it is a fracture, and fractures in monetary history do not close. They widen until the structure collapses. This file uncovers the physical paper divergence already running inside the silver market, the legal architecture that redefines your ownership of any asset held in a custodial account, and the historical script that proves this mechanism has been executed before, with precision, in 1980, in 1873, and in the final years of every empire that believed its financial system was too complex to fail. This is not financial advice. I'm not a licensed advisor. Your capital is your responsibility. Always conduct your own research. Start with the miners. Because the miners are the first ones to see the fracture up close. Pan American Silver, one of the largest primary silver producers on the planet, reported a realized silver price of $69.74 per ounce in their most recent production data. The COMEX average for the same period was $55.20. That is a 26% premium, which means the people who are actually pulling silver out of the ground are getting paid 26% more than what the paper exchange says the metal is worth. Read that again slowly. The paper market says one price. The physical market is paying another. That gap has a name in monetary forensics. It is called backwardation. And historically, when it appears in a hard asset market, the paper price does not pull the physical price down. The physical price pulls the paper price apart. Now add the dealer data. A major physical bullion dealer operating out of Singapore reported $350 million in sales volume in a single calendar month. Revenue split, 50% gold, 50% silver. You see, that is not a retail transaction. That is institutional accumulation running through a civilian channel. The volumes are too large. The velocity is too high. And the geographic signature, Singapore, not London, not New York, tells you exactly which hemisphere is doing the buying and why they are deliberately routing around Western exchange infrastructure. Which means the $81 spot price on your screen is not a ceiling. It is a floor reading from a market that is already bifurcating. Now here's where most analysts stop. They see the premium, they calculate the gap, they tell you silver is undervalued and you should buy. That is the comfortable conclusion. That is also the incomplete one, because the divergence is not just a pricing anomaly, it is a pressure gauge. And right now that gauge is registering something the COMEX has not had to manage since the Hunt brothers pushed it to the edge of structural failure in February of 1980. Back then, the exchange changed the rules mid-game. They called it liquidation-only trading, which means they legally prevented any new long positions from being opened. The price collapsed in 11 days, $50 to $10, not because the metal disappeared, because the paper mechanism was weaponized. The question you should be asking right now is not whether silver is worth $81. The question is, who controls the mechanism that decides when the paper price and the physical price are allowed to converge, and what happens to your position when they pull that lever again? If this forensic sequence is locking in for you, if you are starting to see the architecture behind the number on the screen, the forensic circle covers these divergences in real time as they develop. Subscribe, not because you want more content, because the next data point in this sequence drops before the broader market catches the signal. That is the only reason it matters. But here is what the miner premium and the Singapore volumes do not explain. They do not explain why one major bank removed 13 million ounces of silver from registered COMEX inventory in a single month in late November. That is not a hedge. That is not a trade. That is preparation. And the legal framework that makes that move not just possible, but entirely protected, is written inside a document most investors have never read, and were never meant to. 13 million ounces, removed from registered COMEX inventory. One institution, 1 month. That number needs context before it can be understood. Because on the surface, it looks like a large trade. It looks like a hedge fund taking a position. It looks like normal market behavior. You see, that is precisely what it is designed to look like. The COMEX operates two categories of silver inventory. The first is called eligible. Metal that is stored in a COMEX-approved vault, but has not been formally committed to the exchange. The second is called registered. Metal that has been officially designated for potential delivery against a futures contract. Registered inventory is the number that matters. It is the physical collateral backing the entire paper market. When 13 million ounces move out of registered inventory in a single month, the ratio of paper contracts to physical metal does not stay flat. It spikes, which means every remaining ounce of registered silver is now backing a larger stack of paper promises. The math on that is not complicated. The math on that is a countdown. But here's the question the inventory data alone cannot answer. Why November? Why pull that volume now, at this specific moment in the credit cycle? To answer that, you need to look at a deadline most retail investors have never been told exists. Between now and June of 2026, approximately $2.2 trillion in commercial real estate debt reaches maturity in the United States alone. That is not a projection. That is a contractual schedule. The loans were written, the terms were set. The clock has been running since 2021 and 2022, when the commercial real estate market was still functioning inside a zero interest rate illusion. Those loans are now maturing into an interest rate environment that is fundamentally incompatible with their original underwriting assumptions, which means the banks holding that debt are facing a simple but catastrophic arithmetic problem. The collateral, office buildings, retail centers, commercial properties, has declined in value. The debt attached to that collateral has not. Under Basel III capital adequacy requirements, banks are required to hold a specific buffer of what regulators call high-quality liquid assets, HQLA, against their risk-weighted exposure. You see, when the collateral on your loan book deteriorates, your HQLA requirement increases, which means the banks approaching the 2026 maturity wall are not just managing bad loans. They are in a silent race to accumulate assets that qualify as HQLA before the regulatory window closes. Gold qualifies. And, as of 2024, under Basel III's updated net stable funding ratio provisions, physical silver held in allocated accounts is being evaluated in certain institutional frameworks as a Tier 1 adjacent asset. Not officially classified, not publicly announced, but the positioning data from the COMEX tells you everything the press release does not. 13 million ounces. One institution, 1 month. That is not a trade. That is a bank quietly filling a regulatory hole before the auditors arrive. Now here is the head fake. Most people watching this sequence will conclude the banks are buying silver, therefore silver goes up, therefore you should buy silver. That is the comfortable logic. It is also incomplete, because the move that actually threatens your capital is not the buying. It is what the buying reveals about the legal architecture already surrounding your existing holdings. The Uniform Commercial Code, specifically Article 8, governs the legal relationship between investors and the financial intermediaries holding their assets. It was revised in 1994. Most investors have never read it. Most financial advisors have never explained it. And the reason for that silence is embedded in a single legal classification. Under UCC Article 8, when you hold a security, a stock, a bond, an ETF, or a digital silver position through a broker or custodial account, you do not hold the asset. You hold what the code calls a security entitlement, which means you are not a property owner. You are an unsecured creditor of the intermediary. Read that again. Unsecured creditor. The same legal classification as a supplier who shipped goods to a company that subsequently filed for bankruptcy. The practical application of this is straightforward. If the institution holding your silver ETF position enters insolvency proceedings, particularly under a resolution framework, your security entitlement does not give you a priority claim on the underlying metal. It gives you a claim on whatever assets remain in the general estate after secured creditors are satisfied, which means the metal you believe you own was never legally yours to begin with. Now layer the second statute on top of the first. Title II of the Dodd-Frank Wall Street Reform Act, passed in 2010, created the Orderly Liquidation Authority. The OLA gives the Federal Deposit Insurance Corporation the legal power to seize and resolve a systemically important financial institution outside of standard bankruptcy proceedings. Here's what that means in plain mechanical terms. Under a standard bankruptcy, creditors have legal recourse. Courts adjudicate claims. Timelines are defined. Under an OLA resolution, the FDIC moves first and litigates second, which means by the time your legal claim is formally recognized, the asset transfer has already been executed. The system is not broken. The system is working exactly as it was designed to work. The Dodd-Frank architecture was drafted in the aftermath of 2008 specifically to prevent a disorderly collapse from becoming a systemic contagion. The mechanism that prevents systemic contagion is the legal transfer of risk from the institution to the depositor. That is not a conspiracy. That is the fine print. Now close the triangle. China's state-affiliated entities have been progressively cut off from COMEX delivery channels since 2023 through a combination of exchange rule amendments and settlement restrictions tied to sanction-adjacent regulatory frameworks. The result is mathematically predictable. A buyer of that scale, unable to access the primary paper market for physical delivery, does not stop buying. They route around the infrastructure. Chinese procurement agents are currently paying $10 per ounce premiums directly to mining operations in Peru, Mexico, and Chile. $10 above spot in direct off-exchange contracts, which means Latin American mine output, the same output that historically replenished COMEX registered inventory, is now being contracted forward before it ever reaches the exchange. Run those three variables simultaneously. A $2.2 trillion maturity wall forcing institutional HQLA accumulation. A legal framework that reclassifies your custodial holdings as unsecured credit exposure, and a geopolitical squeeze removing primary supply from the Western exchange system at the source. That is not three separate stories. That is one mechanism running three simultaneous inputs toward a single convergence point. June 2026. The loop is now closed. The $81 spot price was never the signal. The signal was the 13 million ounces disappearing from registered inventory while the legal architecture quietly reclassified who owns what. And the supply routes feeding the paper market were severed at the mine. The question is no longer whether the mechanism is running. The question is whether your capital is positioned inside the mechanism or outside it. If the UCC Article 8 framework is new to you, if no one in your financial circle has walked you through the legal distinction between holding metal and holding a security entitlement, the gap in your forensic map is exactly what this channel exists to close. Subscribe to the Forensic Circle, not for the content, because the June 2026 window is not theoretical. It is a contractual deadline, and the institutions on the wrong side of it are already moving. But here is what the maturity wall and the legal architecture still do not explain. They do not explain why this specific sequence, institutional hoarding, legal reclassification, supply route severance, has appeared before. Not once, 3 times in 3 separate empires. Each one convinced its financial system was structurally unique, each one wrong. The historical script running underneath 2026 is not a theory. It is a documented pattern with a known final stage. And the data on where the United States sits inside that pattern is the part of this briefing most people are not prepared to read. Have you ever wondered why great empires fall? We often think of dramatic battles or political scandals, but what if one of the biggest reasons is something you carry in your wallet every day? Let's dive into the fascinating and often overlooked story of how money, or more specifically, the debasement of currency, has been a silent architect of decline for centuries. Our story starts in ancient Rome. At its peak, the Roman denarius was a silver coin trusted across the known world. It was pure, heavy, and a symbol of Roman power. But as the empire expanded and wars became more expensive, the emperors faced a problem. They needed more money than they had silver. What did they do? They started mixing cheaper metals like copper into their coins while keeping the face value the same. This is called debasement. Initially, no one noticed. A denarius was a denarius, but over time, people aren't so easily fooled. They realized the new coins were lighter and less valuable. Merchants started demanding more coins for the same goods. Prices skyrocketed. This is inflation, a concept we're all too familiar with today. The average Roman citizen saw their life savings evaporate. The trust in the government and its money was shattered. This economic chaos weakened the empire from within, making it vulnerable to external threats. The once mighty Roman Empire didn't just fall to barbarian hordes, it was also eaten away by bad money. Fast forward a few centuries to the Spanish Empire. In the 16th and 17th centuries, Spain was swimming in silver and gold from the New World. They were the wealthiest nation on earth. But instead of investing in their own economy, they spent lavishly on wars and luxury goods. They minted so much money that the value of their silver coins plummeted, not just in Spain, but across Europe. They experienced massive inflation, which crippled their domestic industries. Farmers and craftsmen couldn't compete with cheaper foreign imports. Sound familiar? Once again, an empire built on vast wealth found its foundations crumbling because it mismanaged its currency. Now, let's jump to a more recent example, the British Empire. For a long time, the British pound sterling was the world's reserve currency, backed by gold. You could literally walk into the Bank of England and exchange your paper pounds for a fixed amount of physical gold. This created immense trust, but after 2 devastating world wars, Britain was deeply in debt. Maintaining the gold standard became impossible. In 1931, they abandoned it. The pound was no longer as good as gold. While the British Empire's decline was complex, this financial shift marked a major turning point, signaling a loss of economic dominance that paved the way for the rise of a new global power. So what does this history lesson mean for us today? For decades, the US dollar has been the world's reserve currency. But since 1971, it hasn't been backed by gold. Instead, its value is based on trust in the US government and its economy. We are living in an era of what's called fiat currency. Money that is money simply because the government says it is. And just like the Romans, we've seen a massive expansion of the money supply, especially in recent years. This brings us to a critical concept: the divergence between paper assets and physical assets. Paper assets are things like stocks, bonds, and the cash in your bank account. Their value is based on promises. Physical assets are tangible things you can touch: gold, silver, real estate, even fine art. Throughout history, during times of currency debasement and high inflation, the value of these physical assets tends to soar, while the purchasing power of paper money plummets. Think about it. When people lose faith in their currency, they don't want to hold on to pieces of paper that are losing value every day. They rush to exchange that paper for something real, something that has held its value for thousands of years. This is the flight to safety. We saw it in Weimar Germany in the 1920s, when people were using wheelbarrows of cash to buy a loaf of bread, but a single gold coin could buy a house. Today, we are seeing signs of a similar divergence. While stock markets can be volatile, the prices of real estate, precious metals, and other tangible goods have seen significant increases over the long term. This isn't just random market noise, it's a reflection of more and more money chasing a limited supply of real stuff. The very fabric of our economic system is being stretched. The value of our savings, our salaries, and our pensions is directly tied to the stability of our currency, so the pattern is clear. From Rome to Spain to Britain, the story repeats. Governments overspend, they debase their currency to pay the bills, the public loses trust, and the value of paper money collapses relative to real physical things. It's a cycle as old as empires themselves. Understanding this historical pattern isn't about predicting doom, it's about being informed. It's about recognizing that the value of the money in our pockets is not guaranteed. By looking at the past, we can better understand the forces shaping our world today and make wiser decisions for our own financial future. The lessons of history are written not just in stone monuments, but in the coins and currencies that have risen and fallen with the great empires of the world. What do you think? Is history repeating itself? Let me know your thoughts in the comments below. Thanks for watching, and don't forget to like and subscribe for more deep dives into the topics that shape our world. See you next time. The exchange's response was immediate and surgical. New rules, liquidation only, no new long positions. The price collapsed from $50 per ounce to under $11 in 11 days. You see, the Hunt brothers did not lose because their analysis was wrong. They lost because the mechanism they were trading inside had a manual override, and the people holding the override lever used it. Which means the question for 2026 is not whether the analysis is correct. The question is, who holds the override lever now, and whether the geopolitical fragmentation of 2026 leaves that lever intact or dismantles it permanently. The 7-stage imperial collapse pattern is not a theory. It is a documented sequence extracted from the decline of the Spanish Empire, the British Empire, and the Soviet Union. Stage 1, excess money creation to fund military and social obligations. Stage 2, asset price inflation masking real purchasing power decline. Stage 3, wealth gap acceleration as financial assets outpace wages. Stage 4, political polarization as the middle class recognizes the extraction. Stage 5, resource hoarding by institutional actors ahead of currency debasement. The United States is at stage 5, not approaching it, not entering it, inside it. The evidence is not a forecast. It is the COMEX inventory data. It is the critical minerals reclassification. It is the Basel III HQLA accumulation race. It is the Latin American mine contracts being signed in Beijing. Every empire at stage 5 believed it was the exception. Every empire at stage 5 had academics and officials explaining why the historical pattern did not apply to their specific circumstances. The math did not care about their exceptionalism. The math does not care about ours. Stage 6 is currency debasement at a rate the public can no longer ignore. Stage 7 is institutional restructuring, which is the technical term for who loses their savings and who does not. The final block of this file covers who survives that restructuring, and the specific move the system makes in the final window before June 2026 closes. Here's what this file has handed you. The $81 spot price is not a signal to celebrate. It is a pressure gauge on a fracture that is already running. The institutions know the June 2026 deadline. They have known it since the loan contracts were written, which means the 13 million ounces pulled from registered inventory, the Latin American mine contracts signed in Beijing, and the Basel III accumulation race are not separate events. They are coordinated positioning inside a sequence that has a known final stage. You now have the forensic map. Most people watching silver hit $81 will see a commodity price. You see a maturity wall, a legal reclassification, and a geopolitical supply severance running simultaneously toward a single convergence point. That gap between what you see and what they see is the only gap that matters. The forensic circle exists for the people who refuse to be the last ones holding the paper promise when the window closes. If this briefing gave you data your financial advisor has never mentioned, if UCC Article 8 was not in your framework before today, subscribe, not for the content, because the next file in this sequence covers the specific timeline of the FDIC resolution framework and the exact trigger threshold that activates the orderly liquidation authority. That file is being prepared now. The system does not break, it resets. And the reset is always designed in advance by the people who wrote the fine print. For the people who never read it, the debt is real, the vault is empty. By June 2026, you will either own the metal or you will own the debt.